Hey everyone, welcome back to the channel. So in this tutorial, I am going to show you how to invest in the stock market. So what we're going to do here, we're going to break this down into a number of parts here within this video, so you can skip around if you would like to, but we're going to try to make this as in-depth as possible, a full, all-inclusive tutorial showing you how to invest into the stock market. Obviously, right now we're in some turbulent times in the markets, and so people are interested in investing. So what I'm going to do here is I'm going to break this down into a couple of different sections. First of all, we're going to talk about a lot of common questions that people have of how to actually start investing, what brokerage firms should you use, how much money should you start with, what are some of the initial techniques that you can use to find stocks, or what type of investor should you be. Then later in the video, we're actually going to talk about stock market research. We're going to talk about qualitative versus quantitative research. We're going to talk about looking at different income statements, balance sheets, cash flow statements. We're going to really try to go as in-depth as possible. So we try to make as many personal finance videos as possible on this channel. So if you want to watch more videos like this, the only thing that we ask is that you subscribe to the channel and drop a like if you find value in this video. So without any further ado, let's get started here. But I first want to just kind of run over a couple things that we are going to discuss here. First of all, we're going to talk about the different types of investing, right? There's different types of investors. You can do investments that are rather short-term versus investing that is rather long-term. Then we're going to talk about how to actually buy stocks, brokerage firms that you can use, ones that I would probably avoid, some things that you want to avoid in that area. Then we're going to talk about passive versus active investing. What type of investor would you like to be? There's some people who have a lot of time on their hands and they want to really learn the ins and outs of the markets and the financial markets, whereas some other people just want to do it passively. They want to take some of the money from their job, from their work, maybe put it into their 401k, but they want to make sure that they're doing it correctly. Then we're going to talk about stocks versus mutual funds versus bonds versus ETFs and index funds. You probably hear a lot of this jargon being thrown around. We're going to kind of dissect that to hopefully get a better understanding of it. And then we are going to talk about how much money should you start with. Should you go all in? Should you put as much money as you possibly can into the markets now? We're going to talk about diversification a little bit. We'll also touch on an idea of something known as dollar cost averaging as well, something that some people like to do. Then in the latter half of the video, what we are going to discuss is quantitative versus qualitative strategies for understanding stocks, looking at them from both sides there. We're also going to talk about where to gather your information from, Form 10Ks, 10Qs, talking about websites that we can use to find a good amount of information. And then, as I said, we're going to look at some of the financial statements as well to actually start to understand how to value a stock. How do we value a stock and decide whether it's a good deal or a bad deal? Now, one of the biggest ideas of investing that we try to preach here on this channel is to try to limit as much risk as possible while increasing the potential reward. That is the goal of investing. Sometimes people get a little bit confused about that, and I want to just give a little bit of a forewarning here before we actually start talking about some big things here, and that is to curb your ego. Now, I don't want that to come off in the wrong way, but the one thing that I would like to bring across here is to make sure that when you are investing, especially if you are just beginning investing, make sure that you are making investments based off of actual logic rather than emotional investments. I know when I first started in the markets, I would start to buy stocks on a whim. I would see somebody on the news, I would see Jim Cramer talking about buy this stock now, and I would just go out and I'd buy it right away within 5 minutes, not really knowing anything about the company. So what I suggest that you do is try to find a buddy or a friend who might also be learning about investing, or maybe they've already been investing for a long period of time. Call them up, talk to them, and kind of use sort of this buddy system so that before you make any investment, you call up one of your friends or associates and tell them about this investment that you're thinking about making, run it over with them, see what they have to say about it, some of their concerns about it, and it really kind of creates this better way to invest so that you can throw ideas and bounce ideas off of each other. And so that's just something that I would suggest doing. So let's actually start by talking about the different types of investments. So there's different strategies for investing. Maybe you've heard of some of these known as technical analysis, and then there's others such as fundamental analysis, and then there are other strategies as well. Something that people like to do, which is sort of passive index investing, where they dump money in through dollar cost averaging. Those are really the three primary strategies for investing. And then there's also another one that we'll touch on briefly, which is more so behavioral finance, going off of the news, going off of trying to understand people's emotions and making investments from that perspective. Now, on this channel and what I do and what the majority of investors on Wall Street and throughout America and throughout the world do is they use some type of fundamental analysis. And this is through long-term investing where you are trying to find companies that their current valuation, the current stock price, is lower than what it should be at the moment. And so there's a number of ways to do this, but first let's actually just discuss a couple of others before that. And one of those is technical analysis. And this is actually something that you probably will hear when you look at somebody who maybe is a day trader or swing traders or very quick traders. People who get into a stock and get out of a stock based off of technicals, based off of the actual stock charts. So the truth is most investors, myself included, I don't actually sit in front of like 3 big monitors and looking at stock charts all day long and watching as every couple of minutes those stock charts change and we see the price go up and down and up and down. Really what I'm focused on is long-term investing. And as I said, most people on Wall Street focus on long-term investments as well. So we're not so much worried about the day-to-day activity, but more so over the span of months and over the span of years where that company is going to be. Now, you can certainly get into day trading. You can certainly get into penny stocks and swing trading. It can be very attractive. I know people who make quite a bit of money in those. And actually, I would suggest picking up some books simply like this, Technical Analysis for Dummies. I actually love these For Dummies books, but this video is not really about technical analysis. We're focusing on long-term investments that can really build wealth. And I should also mention that I'm not actually a financial advisor. I'm just a random person on the internet. So make sure that with all of this information that you are learning here in this video, make sure that you go on your own and start to really kind of learn more for yourself. Because like I said, I am just a random person. I have been investing for some time, but I just wanted to make that very clear. Okay, so let's talk about how you can actually buy stocks. People have wondered this for some time. They say there's so many different companies out there and I see these advertisements for it. How do I actually buy a stock? We'll touch on this very briefly because I think some people already kind of know how to do this. Or to be honest, you could just go onto the App Store and type in investing app and you can find one on there. But there's a couple that I really like, but there's also a lot that you probably have already heard of before, like TD Ameritrade, Charles Schwab, Fidelity, Vanguard. Those are the more traditional ones. And then we see a lot of newer ones in the past few years, like the Robinhood app, M1 Finance, which is one of my favorites. I just like working with them. And then there's others as well, like Webull, and I've seen a number of others popping up as well. I saw something like Public popping up. So there's a lot of different apps that are available. I'll leave some links to some of those down below if you're interested in signing up. I think it might be an affiliate link, so I might get some money if you sign up for it, but you totally don't have to do that. You can just go and Google it if you would like to find some different brokerage firms. But to be honest, it doesn't really matter which brokerage firm you go with. A lot of them today are pretty similar to each other. They have very similar features to them. As I said though, I really do like M1 Finance because you can do fractional shares investing. Whereas, for example, if you wanted to invest into Amazon stock, and looking at Amazon stock here, it's almost $2,000 per share. So traditionally, if you wanted to buy one share of Amazon stock, you would need to actually have almost $2,000 to buy that. You wouldn't be able to buy half of a piece of one Amazon share, right? Well, now you can do that with something like M1 Finance. This is not a big advertisement for them. It's just something that I actually do like about them, but also there's a very low amount of money required to actually start investing. You can start accounts with $100 or less for most of these different brokerage firms. Now, let's actually talk about stocks and what a stock specifically is, just briefly, because I know for some people that's been kind of a concern of what actually is a stock. How does it function? The most basic way to put this in a couple of sentences here is that a stock is essentially just a piece of a company that you own. So when I bought my very first stock, my very first share of a company in 2009, it was Cedar Fair, and I paid, I think it was $12 for one share of Cedar Fair stock. It was not a very good move, but I bought one share for $12. What this means is that, let me pull up Cedar Fair stock right here and just show you exactly what this actually would mean. So if you buy one share, currently the price of Cedar Fair is $18.34 per share. So if you buy one share, that means that you own a tiny sliver of this company. You actually own a piece of this company. It's not that you're speculating on it. You actually own a piece. And so what can happen here, and depending on the type of company, you can actually get invited to shareholder meetings. I know that I used to get invited to Cedar Fair shareholder meetings. They would actually give me free tickets to their amusement park, even though I only had a few shares. It's actually a pretty good deal. But you can actually get invited to the shareholder meetings, especially if you own a lot of shares of a company. For example, if you own one share, you're not going to really have much say in a company, but some people who own 10, 20, 30% of a company can actually vote on certain things that the company does. They can vote on who's going to be on the board. So it's really, really interesting how this can work. But yes, you own a piece of the company. Unlike bonds, where bonds you're going to be essentially loaning money to companies and then they're going to give you that money back with a little bit of money on top as an interest rate. Well, with stocks, you actually have some equity in that company. And that's the best way to view it. Hopefully that kind of clears it up. If you're still a little bit confused, you'll probably just learn more throughout this video as we sort of explain how these stocks function, but that is the basic understanding of it. So let's actually go back to where we were here. We talked about how to actually buy stocks, open up a brokerage account. Like I said, M1 Finance is one of my favorites. It's super easy. Once you sign up, you can sign up for an individual brokerage account, or you're probably going to see a ton of different options when you're signing up, where you might see you're going to have an IRA, potentially. You're going to have joint accounts, custodial accounts. If you're under the age of 18 in America, then it's going to be difficult to invest into the stock market. You can still do it. You're just going to need to get your parents' help with that. It's technically going to be called a custodial account, so it's under their name, but your name is attached to it as well. And so I'm not sure on the entire legality of whether or not you legally, if you're under 18, are allowed to control that money, but it has your name on it. And I know when I was younger, and this is not advice here, but when I was under 18, I had access to my account and I was investing with that, and I just had one of my parents on that account, so I could get started with that. So like I said, if you're under 18, you can still totally do this. You just need a little bit of help from some type of adult. Joint accounts, there's going to be IRA accounts, there's going to be a number of different ones. The basic one, the most simple one, is just going to be an individual brokerage account. It's probably the one you're going to see at the top of the list when you were signing up for opening up a brokerage account. Okay, so let's talk about passive versus active investing here. Which one is going to be the best option? Obviously, this depends on you as a person and how much time you have on your hands. So I'll tell you this, that for the first few years of my investing journey, I actually spent a lot of time looking into individual companies, investing into individual stocks, because I had a lot of time to not only read a lot of books, which is something that I suggest. People ask, what's the best way to learn how to invest? Two ways. One, reading books. Read a ton of books, read at least a dozen, 2 dozen books. You're going to learn so much. But also, the other way to learn is through experience. It's through making mistakes and then learning from those mistakes. But as I was saying, there's two ways to really go through investing here into the stock market. You can be a passive investor or an active investor. Active investors, from the way that we do this, from our approach, is to, I would say, roughly about at least once a week at a minimum, you're looking over each one of the stocks that you own. You're looking at the news from those companies, making sure that everything is going smoothly. If there's any red flags, you're able to recognize those red flags, at least on a weekly basis. So you're still putting in some hours for that. I would argue that people might put in anywhere from 5 to 10 to maybe 15 hours per week of actually reading about companies, learning about companies, and making sure that the investments that they have or future investments that they're looking into are in good condition. Now, if you don't have that time on your hands, because I know a lot of people are struggling to find time in their day, well, if you don't have time on your hands for that, you could take an active or a passive approach to investing as well. Now, one approach is not necessarily better than the others, but from a passive approach, a lot of people do something called dollar cost averaging, and they do this into mutual funds and ETFs. Maybe you hear people talking about investing into index funds through dollar cost averaging. This is a strategy that many people use as well. It's certainly been tested, especially now we're in April now of 2020, so it's certainly been tested with the markets seeing pretty volatile times, but this is an approach as well, and we will talk about that passive investing strategy. What we're really focused on more so today is a little bit more active investing, talking about investing into individual companies and finding good deals within the markets. So let's talk about short-term versus long-term investing as well, something that we need to very much clear up. What type of investor should you be in terms of how long you're investing? And so one thing that I want to make very clear is that the way that we invest and the way that most people who have succeeded very much on Wall Street or in the stock market invest for a long period of time. What we mean by this is that if you are buying a stock and then hoping to sell it in a few days based off of fundamental analysis, that's not really what we focus on. What we want to do is we want to buy a stock that can reap rewards for a very long period of time, for decades to come. So the way that I do this is I'm very much oriented about, if I'm buying a company now, if I'm buying a stock now, I want to make sure that this company is a very good company in 5 years. And so that is one thing that we do want to take into consideration of what type of investor you're going to be. And if you want to make money fast, or if you're looking for just to get rich quick, this might not be the video for you. But if you are still looking for maybe a little bit more thrill, as I said, I would consider looking into some things like technical analysis or day trading, although that can have certainly a lot of risks to it. Now let's talk about stocks versus funds, stocks versus mutual funds, ETFs. So as we mentioned earlier in this video, a stock or a share of a company, you're going to own a piece of one company. But with ETFs, exchange traded funds, or mutual funds, or maybe you hear index funds as well, what these are going to be essentially a basket of stocks that people can invest into. So say that you didn't want to put all of your money into Walmart stock, because you want to diversify. You don't want all of your money going into one company, because what if Walmart has problems next year and their stock price goes down to much lower than what it was today, and you can end up losing a lot of money. And so what some people like to do is they like to invest into ETFs, mutual funds, index funds. They're all relatively the same. For the purpose of this video, we're just going to say that ETFs and mutual funds, they're relatively the same in the sense that they're going to represent an overall basket of stocks. So think about something like VOO. VOO is an index fund which is run by Vanguard. Okay, so Vanguard is a financial institution. You can open up an account with them. I think they're a really good company. So it is essentially just a brokerage firm that you can use here. But something like VOO, VOO, which is an S&P 500 index, it tries to track the S&P 500. So maybe you've actually heard about people talking about the stock market is down 600 points today, or the Dow crashed 7% today. Well, these are actually indexes that essentially kind of show us how the markets are doing overall. So, for example, the Dow Jones Industrial Average represents 30 companies in the United States. Then we have something like the S&P 500, which represents 500 companies in the United States. This is probably arguably the best indicator for how well the U.S. markets are doing, the stock market in the United States, and overall kind of the economy as well. And then there's another index that we see quite often in America, which is known as the NASDAQ, which is much more focused on tech stocks. But then throughout the world as well, most countries or most regions in the world are going to have some type of index that you can see how well that's doing. So in Shanghai, there's an index. In Tokyo, there's an index. In Europe, there's some index funds. And so each one of these is going to be an overall basket of stocks, sometimes maybe 30 or 40 stocks, and other times it could be 1,000 stocks. I know that I have some investments into mutual funds or ETFs that have over 1,000 stocks in that one. So let's say that one share of an ETF is $100. Well, inside of that $100, let's say that that ETF owns 100 companies. That means that I theoretically could have invested $1 into each one of those 100 companies when I bought one share of that ETF. Hopefully that's making sense to you. So it just sort of diversifies your investments. And the pros to this is that, well, let's say that you invest into an ETF like VOO, VOO, which is that S&P 500 index fund. It represents 500 companies. So if you invested money into this, well, you're pretty well diversified. And so what this means is that, let's say one out of these 500 companies goes bankrupt. Let's say they pull an Enron or a Lehman Brothers or a Bear Stearns, and they go bankrupt. They have no money left and they go under, and their stock price goes to zero. Well, if you buy an index fund, if you have money into an index fund, well, if that one company out of 500 went bankrupt, the other 499 should hopefully kind of carry the weight for that, and you wouldn't really feel that much of an effect from that. But on the flip side, if say one of those 500 companies turns into the next Amazon, the next Apple, the next Netflix, and it absolutely booms and the stock price goes from $1 to $1,000, well, you're not going to see much of an effect from that as well, because the other 499 stocks might be sort of weighing it down. So you can see kind of how that has both positives and negatives to it with index funds and ETFs and mutual funds. So hopefully we kind of cleared that up for you. What we're going to actually talk about in the rest of this video is actually focusing more so on individual stocks, because I know a lot of people people want to invest into just a couple of companies. Maybe they want to invest into 10, 20, 30 companies, and they want to choose them themselves rather than just kind of blindly putting money into index funds or ETFs in mutual funds. Okay, so let's actually talk about stock research here. First of all, let's discuss quantitative versus qualitative research. Now, I suggest take out a pen, take out a piece of paper. I hope you already did this, but there's two really strategies for looking at companies. One of them is qualitative research. So this is something along the lines of looking at a company's culture, looking at the motto of the company, looking at their vision, and even the leadership of a company. For example, this is very important because if you are just looking at the financials and the fundamentals and you're looking at the numbers, but you're not looking at who's the CEO. Is the CEO Papa John? Because that might be a problem. So you want to make sure that you are looking at a number of things throughout the culture of a company, making sure that there's no issues within that, some potential problems. I'll give you an example here. Looking at Facebook, right? Facebook, a lot of people are a little bit wary about Facebook because of some of the things that they've done in the past. We saw the Cambridge Analytica scandal. So qualitative research is very important, but I would argue that most people probably spend about 20% of their effort on qualitative research and then 80% of their effort on quantitative, which I think is a reasonable amount to go for. So most of the time that I spend when I look at investments is actually focused on the financial numbers rather than that qualitative things like looking at Facebook and Mark Zuckerberg and looking at their prone to maybe more scandals in the future. Those are all things that you do want to take into consideration. But quantitative the quantitative approach is much more focused on looking at the actual hard facts and the numbers from this. Now, where do you actually get information from when you invest into a stock? There's a couple of ways you can do this. One of them is through just the brokerage firm that you have. So if you're using Vanguard or using Fidelity, a lot of these companies, a lot of these brokerage firms that you can sign up for actually have their own research platforms within that. So if you want to buy some stocks or look at their earning reports, then you can do most of that through one of your brokerage firms that you have through your account. It should be pretty straightforward from that. But what I think is one of the best ways in terms of gathering information to learn about a company. Let's say that you're really interested in investing into Walmart stock. You think about investing into it, you're not quite sure. So you want to learn more about it. You want to learn, okay, well, how does this company's financial statements look? And so one thing that you can do is to go to that company's investor relations report. So a lot of this is going to be on their investor relations page. The best way to find this is just through a simple Google search, or most companies, if you go to their website and you scroll all the way down, let's see if Walmart has one on their homepage. If you scroll all the way down to the bottom, you'll be able to actually just find their investor relations page. So let me scroll down to the bottom of Walmart and see if they have it on here. And it looks like they don't have it on here, but you can certainly find it if you start to click around. But as I said, I would suggest doing a quick Google search and then you can find it. See, so we just click on investors here, and this will take us to their investor relations page, which at this point, you're going to see a couple of things on most companies' websites, especially if they are on the major stock exchanges around the world. They're going to be regulated in the terms of what types of information they have to actually release to the public. So what's really cool about this is that if you're investing into stocks that are on the major stock exchanges, then you're going to actually have a lot of information available to you. So one thing that we see is something called a Form 10K. This is going to be their annual report looking at the past year, talking about the numbers from the past year, and then talking about their projections for the future. So for example, what they believe is going to happen throughout 2020, they laid that out. Usually we're going to see this happen right around the turn of the calendar year, although it might depend for some companies. So what I would suggest doing is downloading what we call the Form 10K. This is probably going to be roughly about 100 pages. Most companies, it might be over 100 pages for that company's 10K. Within here, I want you to be a little bit careful because just a little bit of a warning that this is written by the company. So they're obviously going to try to spin it in a very good light. They want people to invest into their company. This is their annual report that goes out to their investors. And so they're going to try to spin it in a very good light. So just make sure that you're doing your due diligence there and doing thorough research for all of that. Now, there's also going to be things called the 10Qs, which is going to be essentially just sort of an update every quarter of what they're thinking about for the next quarter based off of looking back on their 10K. So if we're in quarter 3, they might reference that and say our projections were a little bit low. I think we're going to outshoot that for the next quarter. The past quarter we did better. So the 10Qs and the 10Ks, some of the best places to get information about a company. You're going to learn a lot just from those. Trust me, if you read 100 pages of a Form 10K from something like Walmart, you're going to learn a lot about that company. All right, now I'm going to give you a little bit of homework, things that I want you to really research more after this video, because for the sake of this, we can't go crazy in depth on every single topic here, because this is something that does take many years to really master these topics. But what I want you to do is start to learn about different ratios and financial metrics that we can use to essentially value a company or see if this company is volatile, if it is a company that is likely undervalued or overvalued. There's going to be some different indicators and ratios that we can use. One of them known as the price to earnings ratio. This is the PE ratio. There's something called earnings per share. We can look at return on equity, return on assets. And then there's also other ones as well. If we go to something like Yahoo Finance here, you're going to see a lot of things that maybe if you've never done this before, it might look like hieroglyphics. You're not quite sure about it. So we'll just kind of run through some of these here. So market cap is the total overall valuation of a company. So if the market cap of a company is $1 trillion, which is only a couple of companies who have hit that mark, that is going to be, well, first of all, quite large, but that is the overall valuation of the company. So we take the number of shares multiplied by the stock price, and that is going to give us the market cap for a company. Looking at some other ones here, something like beta. This is going to essentially sort of indicate whether this company is a volatile stock or if it's not very volatile. So the beta of 1 is going to be average. And then if you see a beta below 1, that's going to mean that it's less volatile than most other stocks. So looking at Walmart here, the beta here on Yahoo Finance as of today, it says that it's 0.43. This means that Walmart stock is less volatile, and volatile means that it's less likely to have massive jumps up or massive jumps down. So if the market, for example, comes crashing down, Walmart stock is probably less likely to come crashing down as hard, but also if the market starts to really boom, Walmart stock might be less likely to really see some massive growth as well. So it's more stable versus if the beta here for Walmart or for a company was 2, 3, 4, if it was a lot higher, then that could indicate that this stock is probably jumping around a lot more. A higher beta is not necessarily a bad thing. It just means that there's going to be more volatility in it. Then there's other things as well. Looking at the earnings date, that is when generally we're going to see companies release earnings reports every quarter. So 4 times per year, they're going to get on conference calls, and probably the CEO and a number of other people are going to discuss the earnings from the past quarter, from quarter 1, from quarter 2, from quarter 3, and they're going to talk about this. What's great about this is that you can actually listen into a lot of these earnings reports and a lot of these earnings calls to see how a company is doing. And if they over-report earnings or if they under-report earnings, that's going to have a big effect on stocks. So this is something that you do want to very much be aware of, that if you're looking at a stock, you're probably going to see some times within the markets where the stock jumps a lot, or if it comes down a lot, maybe a couple times per year or about 3 or 4 times per year. A lot of that is based off of the earnings, because when companies get on these calls, sometimes they say our earnings are much better than what we thought we were going to do. We pulled in a lot more money last quarter. Suddenly the stock in a lot of cases goes up because people get more excited and more bullish on a company. Let's quickly talk about bullish versus bearish just to clear those up here. Bullish, if you're bullish on the stock market or if we are in a bull run, it means that it's going up. You believe that it's going up. Versus bearish on a market or in a bear market, that is going to be when the markets are going down. They're in a slump, right? So that is something, just some terminology there that we can kind of clear up. But looking at some other ones here as well, the 52-week range, a lot of that is kind of self-explanatory. Looking at the stock price, that's self-explanatory. Volume is just how much that stock is being traded. So if we see a big uptick in volume, that could also spur some more volatility as well. But that is something that we want to look at. And then another one is dividend. Okay, so thinking about a dividend of a stock, the best way to explain this in very simple terms is that some companies, with the money that they're making, they choose to give some of that money back to the shareholders rather than reinvest it into their own business, back into the company. They'll choose sometimes to actually pay out dividends to their shareholders. So, for example, here with Walmart, you're going to see a dividend of $2.16. So what this means here is that Walmart's dividend of $2.16, they might be splitting this up over 4 different quarters. So you might expect to get 1/4 or 25% of $2.16 every 3 months from Walmart. And you can actually just get this in cash sent as a check, although most likely most companies are just going to deposit it into your account. And it's sort of like a thank you from a company for investing into that company. Now, that's probably a terrible way to put it, but it is just a small amount of money that they are giving back to their shareholders for owning that stock. So instead of reinvesting it, they're just giving back to their shareholders. Some stocks you're going to see have dividends that are very high. For example, you might see a stock that has a dividend of 10% annually. Actually, a lot of real estate ones that I see have dividends of 10%. And so if a stock is $100 and the dividend is roughly about 10%, you might expect to get $10 extra in cash by the end of the year, split up throughout 4 quarters. Sometimes they pay monthly dividends by the end of the year that company is going to be paying you. I just want to give you a little bit of forewarning on this. Be very careful with dividends. I sort of view them as a cherry on top. I don't really invest for dividends for the purpose of dividends. The one thing that I want you to be careful with is one mistake that I made when I first started investing, where I would look at stocks, I was looking at companies, and I would say, this one company has a 15% dividend or a 20% dividend, and I would invest into it based off of that, not realizing that some of these companies' dividends were not sustainable amounts of money that they were paying out. And so I would end up losing money because I was investing into stocks that had 20% dividend, but they couldn't sustain that dividend. They couldn't pay out 20% per year because they weren't making that much money. And so they ended up going bankrupt, some of those companies, and it was a terrible fiasco. So just be very careful with that. View it as the cherry on top, not really a primary reason for investing. A lot of companies that are what we're going to say are well established, blue chip stocks, companies that have been around for a long time, like to pay dividends. So a lot of these older companies like Ford, General Motors, Walmart here, a lot of these less volatile kind of well-established companies, a lot of the ones in the Dow Jones, for example, pay out dividends as well. Those are some of the things that we wanted to run over here. We're actually on Yahoo Finance, and we might as well just stay on Yahoo Finance to show you some of these other things that we can look at here. So if we actually click on financials, this is where we can find a couple of different financial statements from a company. So there's 3 big primary financial statements that we're going to look at here today in this video, and that is going to be the balance sheet, then we're going to look at the income statement and the statement of cash flows. What I would suggest doing is, if you really want to learn about this, I would really suggest taking an entry-level accounting class or reading a couple of books about accounting to really understand this process. If you've taken an accounting class in college or even in high school, I don't know if high schools offer them, mine certainly didn't, but if you've taken an accounting class, you're going to find this to be much easier to understand. For others, it might be a little bit more difficult, but this is still going to be very, very helpful. So just looking at this here, this is the income statement for Walmart. We can see a lot of things on here that are very relevant, like the revenue. We can look at the past few years for revenue, see whether it's been increasing or decreasing. This is one that's obviously very important to take into consideration. Then we can also look at some very other important things as well, like net income. How is the income of a company? Is it increasing or decreasing? What's the overall trend? Sometimes you're going to see companies that are reporting lower and lower income, but they're still doing better as a company. Sometimes we see companies like Amazon, for example, at some times where their income, their net income is lower, but it's because they're putting money, they're funneling money back into certain areas. So really what I focus on most is the revenue of a company, but you want to look at their costs and where their costs are coming from. So if you see a massive uptick in the cost of a company's employees and they're paying their employees a lot more, and suddenly they have a big extra cost for different legal disputes that they're dealing with. These are all things that you are going to want to really delve into to make sure that you're understanding the financial statements from these companies. So yes, this is the income statement here. Then we can click over to the balance sheet. This is going to be very simply, it's going to be assets versus liabilities. So we can see the number of assets that these companies have on their books here. Once again, I would suggest just learning a little bit about accounting to really kind of learn more about this. We do have some other videos on this, so if you want to kind of delve into a little bit more, you certainly can. But we look at their total assets. We look at the property that they own, the stores that they have, and then we look at their liabilities. What type of debt do they have? Who do they owe money to? How much money do they owe? This is all where you're going to find this in this balance sheet here. Obviously, the total assets is going to balance with the total liabilities and the total stockholder or shareholder equity. So that's going to be the balance sheet. And then quickly, let's hop over to the cash flow statement, which is where you're going to see a number of things in terms of the actual money coming into a company. So I suggest taking a deep look at each one of these. I think there's going to be some great videos that we'll put out in the coming weeks on actually really trying to dig deeper into these. But once again, some of the best ways to do this is through reading books. Now, I have a number of books here. I think these financial books about for dummies are some of my favorites. This one about investing, it's an all-in-one book. There's some great ones about the stock market. I don't know why people laugh about these For Dummies books. I think they're actually really great to learn so much about investing. So I will suggest picking up some of these. I really do think that they're just so helpful. But this one here, The Intelligent Investor, is probably, arguably, the greatest investing book of all time. A lot of people really praise this book a lot. I've read it a number of times and I've gotten so much value out of it that I would suggest reading this, especially if you're interested in building wealth over a long period of time. Now, there's a couple of things that we do need to mention here. One of them being that it's okay if you lose some money at first, but it's important to start with a sort of small amount of money. Now, this is something that I like to advise people on. Once again, I'm not a financial advisor, but I would suggest starting with a small amount of money in the stock market and then building it up over a long period of time. Because as I said, some of the best ways to learn is through reading books, but the other best way to learn is through your mistakes. People make mistakes, and it's very rare to see somebody jump into the stock market and start to absolutely crush it and not make any mistakes. People slip up at some point. They have a lack in judgment. They don't see this one thing within a company that they should have realized, and suddenly they end up losing a lot of money. So the biggest tip that I can have for you is start with a small amount of money, something that you can afford to lose. So if you are living paycheck to paycheck and you have no money whatsoever, then maybe just start with $50 or $100 in the stock market. And then over time, over the months, over the years, you can start to put more money in it. Get your feet wet and then start to jump in bigger and bigger later on down the road once you start to really learn as much as possible. So yes, what I would suggest doing, start today. If you'd like to, start today. Start investing into some stocks today, but start with a very small amount of money. I'll leave some links to those brokerage firms down below. And I think what I'm going to do is I'm actually going to create a group. I don't know if it's going to be a Facebook group or maybe a Discord. I'm going to leave a link for that down below. Maybe we'll do a Discord for people who are interested in investing into the stock market so that we can all talk about stocks together in some type of group chat. I never really did this before, but I think it would really help a lot of people out. And once again, make sure you subscribe to the channel. If you found any value in this, I would highly appreciate if you follow me on Instagram. Feel free to send some questions over there. I try my best to respond to those questions, but it can get kind of difficult if I get a number of people asking big, kind of in-depth questions. It can get pretty difficult. So I hope you can understand that. But thank you for watching. I hope you really found some value in this video. I love creating these videos. It really just makes me happy when I see people starting to invest into the market. So thank you for watching. Invest at your own risk. Remember that you and only you are responsible for the investing decisions that you make. Thank you. Everybody have a wonderful day, and I'll see you in next week's video.